Hi everyone, this is Ali Hussein Kasim of Ali Talks Tech. This week in our weekly roundup of news across Africa, we are going to be covering the 3i Africa Summit. And this is my personal experience as I spent a couple of days last week in Accra. I'll then touch on the new and improved ICT Practitioners Bill that is reared its head again in Kenya. What nonsense. Cybersecurity threats are heightened in financial services across Africa. Again, unfortunately, we are seeing Flutterwave in the news, being at the wrong side of hackers. I'll also cover a super interesting milestone where the Bank of Ghana and the Monetary Authority of Singapore pilot cross-border trade using the ECD and digital tokens that have been approved by the Monetary Authority of Singapore. Lastly, I will touch on Copia, which is a B2B2C e-commerce platform in Kenya that is facing an uncertain future. As I talk about Copia, I will also touch on the current conundrum that is facing a number of e-commerce platforms in Kenya. So back to 3i Africa Summit. So I had the pleasure of spending about 6 days last week in Ghana. And apart from enjoying the sights and sounds of Accra, I had the opportunity to be at the 3i Summit at the Accra International Conference Center. So the 3i Africa Summit is the inaugural summit for a multilateral dialogue to develop Africa's fintech and digital economy, with over 3,000 industry leaders from 78 countries participating. It was a really interesting showcase, and for me, it was something that is worth emulating across Africa, where you're finding that the key host in this event was the Central Bank of Ghana. The event, which was held in Accra from the 13th to the 15th of 2024 this year, featured plenary speeches, fireside chats, panels from heads of state, senior government reps, investors, industry leaders, policymakers, and innovators. It explored and promoted active collaboration between diverse stakeholders groups in key areas, driving innovation, momentum across the region. My personal experience, I had the distinct pleasure and opportunity to be invited into a closed-door meeting of senior central bankers across Africa. I was among maybe 3 or 4 private sector guys, and the conversation was around enabling seamless payments across Africa. And hearing the thoughts from central bankers firsthand across Africa really gave me a glimpse of some of the policy and regulatory concerns that central bankers have when it comes to fintech. And it cemented my thoughts around the fact that, and for good reason, policymakers and regulators would never take up the mantra of moving fast and breaking things, which is something that we in the tech ecosystem think is something we need to be focusing on to grow fast. The fact of the matter is financial services across the world are the most regulated in the world, and Africa is no exception. Great event, and I look forward, inshallah, to the next one next year. I now move to discuss a new bill. This time it's called the ICT Authority Bill. Now, in that bill, there are clauses that should concern every Kenyan. A couple of years back, a number of us across industry came together and fought and won and killed what was then known as the ICT Practitioners Bill in Kenya. It simply purported to say that every ICT player in the country would need to be registered and licensed. Now, seems like this bill is not dead. It seems like it is refusing to die like a cockroach with 1,000 lives. It evolves and it mutates like some amorphous being from outer space. Let me just read a small part of this bill. A person who intends to provide ICT services shall apply to the authority for accreditation in a prescribed manner and upon payment of the required fee. I don't know what nonsense this is, guys, surely. This is rent seeking at the highest level, which is completely unacceptable. For government that came to power on a platform of providing jobs and empowering the youth, this is retrogressive. Guys, let's just be serious. Kenya has earned its place as a tech leader, not just in Africa, but globally. This sort of thinking will take us back decades. Every right-minded Kenyan should be fighting these clauses within the bill. My take is that generally, the ICT bill is not necessarily a bad thing. I'm just saying there are aspects of it just need to be rejected completely and in total. A few days ago, Flutterwave, which is the Nigerian Fintech giant, reported again unauthorized access to its systems, and a couple of $1 million were moved from their accounts. I think this brings to the fore the issues policymakers and regulators get worried about when it comes to fintech. And I believe that the ecosystem needs to take cognizance of this. Now, no system is 100% safe, but we need to make sure that we've got our T's crossed and our I's dotted when it comes to cybersecurity. I'm now looking at the story around the Bank of Ghana and the Monetary Authority of Singapore piloting cross-border trade using the ECD and digital tokens. They have successfully done this pilot. This marks a critical point in how money moves in cross-border trade across Africa. This project aims to promote trade between micro, small, and medium enterprises in both countries. But I'm hoping that this will be the vision for Africa. It is unfortunate that intra-Africa's trade is lowest. Africa trades less with itself than it trades with other countries outside Africa. This must change for us to derive value across our ecosystems, micro, small, medium enterprises, and even the larger enterprises. Last but not least, today I want to cover the story around Copia and touch on the woes that are happening in the e-commerce ecosystem in Kenya. A few days ago, Copia Global, which is a B2B e-commerce platform based in Nairobi, announced that it would likely lay off 1,000 employees in the last few days. In the last 2 years, a number of tech startups in Kenya related to serving the last mile and agri-food ecosystem have gotten into trouble, pivoted, or closed shop. Let me mention a couple of them, the largest ones. Sendi closed after it raised $26.5 million in disclosed funding from several investors. Sendi allegedly struggled with operational sustainability, financial challenges, and market volatility. 2. Trigger Foods, which raised $160 million In August last year, the firm announced that it will be shedding a third of its workforce as part of its strategy to cut costs by up to 40%. The then CEO, Peter Njonjo, blamed a funding drought that had enveloped the market. Since then, the founders have exited the business from an operational perspective. Number 3, in Q4 2022, Wasoko was valued at $501 million, shortly after the startup secured a $125 million Series B investment co-led by Tiger Global Management and Avena at a $625 million valuation. My God. Meanwhile, at that time, Wasoko revealed to TechCrunch that it only received $113 million out of the total funding raised in that round. In December 2023, a couple of months ago, a merger between Max AB, an Egyptian e-commerce platform, and Wasoko was announced. Rumor has it that this was forced upon them by one of the major investors in both the companies. Last month, that's number 4, homegrown e-commerce startup Marketforce announced it is shutting down its business-to-business distribution business called Reja, citing razor-thin margins that have made it a struggle to attain profitability at a unit level. On the other hand, players in the same space like Gobeba and Vituzote are thriving. So what are they doing right? For starters, and I'm saying this tongue-in-cheek, but I'm serious, I'll take you back to 1895. The retail trade has been evolving slowly but surely since then. Since the first Indian coolies arrived in Mombasa, circa 1895, to build the East African railways, and some of them realized that trade was better than lifting steel and timber to build the white man's iron snake. The retail trade, both FMCG and actual foodstuffs, is dominated by the informal trade. Now, I was having a conversation with a good friend of mine, Robert Yahweh, and he tells me his consensus is simple. Even the fact that you're calling it informal trade when it accounts for 85% of all trade is mischievous. But apparently this informal trade has little respect for huge capital infusions from venture capitalists and the tech that comes with it. Why isn't all this money? The above 5 companies that I've mentioned above has raised over $380 million. So the question is, why isn't all this money and all the tech bumping off the Mkokotoni trader from the value chain? Once we answer that question, I suspect we'll get closer to where we want to go. That's it for this week, ladies and gentlemen. I look forward to speaking with you again next week. Thank you. Over and out.